So my points, first, I would note that mutual funds in their current form have been around for a long time, 75 years now, and they've weathered all kinds of adverse market conditions without noticeably contributing to systemic risk. Indeed, they may provide a diversity of sources of funds for borrowers and may have had stabilizing influences on aggregate credit. What I want to show is that these funds have grown relative to the economy and to the rest of the financial sector. I will argue that while mutual funds are still largely a simple intermediation function between borrowers and savers, that intermediation has gotten somewhat more complex. And I'll use two simple examples to make this point. One is their move into more illiquid assets. And one example of use of leverage in that case is derivatives to gain exposure. The growth of funds and their greater linkages with other financial intermediaries does raise the potential that their actions under stress could have effects on the broader financial system. One example is that risk management at individual funds may not be sufficient for systemic risk if, for example, risk management ignores some sources of risk, systemic risk, such as correlation risk. That's just an example. Before I get into I'm going to just have like a couple slides with some pictures. Before I get into that, I do want to emphasize the issue for financial stability is not about market risk or the volatility of asset prices that are just part of the normal functioning of capital markets and capital allocation. Neither micro or macro prudential policies are aimed at regulating asset prices. That is not the intent. The case for policy here is if the structure of the intermediation were some ways would amplify shocks and beyond the value of the fundamental value of the security. So really is an amplification mechanism. Is there something about the structure of funds?